Thank you for attending our inaugural Trusted Advisor webinar series. I'm Andy Sullivan. I'm the Senior Director of the Trusted Advisor program here at NextTurn. And I would like to just tell you a little bit about that program before we get started with our content from our partner Avalara today. Earlier this year, our leadership team made the decision to shake up our typical relationship with our customers, prospects, and partners by creating the Trusted Advisor program. As the premier NetSuite partner in the Southeastern United States, with over 500 implementations across the country, and more importantly, a team of former controllers, information leaders, and other management types, we have a lot of insight to offer across automation maturity and systems that companies may be considering. From companies beginning their automation or upgrade journey to those mature organizations looking to optimize their current operating environment, we seek to advise, educate, and help tackle the tough issues that come up around ERP, CRM, and commerce. But today we're here to discuss probably one of the most important developments in sales tax compliance in years. Right up there with the data privacy things that are changing for anyone doing business internationally. I think this is, really a landmark issue that George is going to talk about. And with that, George, I will hand it over to you.
Great. Thank you very much, Andy. I appreciate it. And thank you, Christina and NextTurn, for allowing me to speak in front of all you. It is an honor. Quickly, what I'm going to be talking about briefly is just talking about the current sales tax law that has changed with Wayfair versus South Dakota. The Wayfair versus South Dakota seriously impacts the business than the way you're running it today. So what are we going to talk about? We'll talk about the economic nexus as a result of Wayfair versus South Dakota, the various types of nexus, states in action, and how rapidly it's been changing over the last even 6 months. What should you do to register, ways to automate, reference resources that you may have, and any questions and answers. I try to keep it to the point. I do not like to waste a lot of my partners' times or clients' times, so I'll just jump right in and get into this. It shouldn't be any more than half an hour or so. So talk about South Dakota versus Wayfair, which is the ruling that just came out in May. What you first need to know about is the Quilt versus North Dakota ruling that was in 1992. And what the Quilt Corp versus North Dakota ruling was North Dakota wanted the Quilt Corp to charge sales tax to its residents because it's been wanting to collect that sales tax for income revenue. And the problem is that 32 states right now are operating at a deficit. So states for years have been trying to figure out how to collect more sales tax. Well, in 1992, Quilt Corp argued that they did not have a physical presence in North Dakota, so they weren't required to collect sales tax to those residents. The Supreme Court sided with the Quilt Corp and said, you know what, you do need to have physical presence. However, that being said, they were going to leave the interpretation of what actually was physical presence to each state. So fast forward now to 2018, now you have South Dakota versus Wayfair, which is exactly the same argument. The only difference is between the argument from 1992 and 2018 was one huge factor, the internet. The internet has completely changed the landscape of how companies do business, and there is an unfair advantage to internet online retailers to brick and mortar locations. So the people that were actually living and conducting business in your state were unfairly disadvantaged. So in a 5-4 ruling, and it wasn't even past party lines, it was actually a nonpartisan type of ruling, which was interesting. The Supreme Court said that, you know what, you no longer need a physical presence to actually be required to charge sales tax. So who were affected? Remote sellers who are not currently registered within the state and who meet these threshold requirements. Annual sales of $100,000 or 200 transactions into the state of South Dakota. Now, keep in mind, a lot of people, some people may do business in South Dakota, but I'm sure more people do business throughout the rest of the country, whether it's mostly the Southeast, whether it's California, Texas. Every state has now changed what those requirements are. And I'll get to some examples in a little bit of what that means. So the new effective date is actually January 1st, 2019. But the biggest impact from South Dakota versus Wayfair is that physical presence rule has now been overturned. So because it's unsound and correct, now what the states are doing is now they're moving into this economic nexus change. And I'll get into this in a little bit. So what happens only in the state of South Dakota? Well, if you're already registered in the state, it does not apply to you. It only applies to companies that are not currently registered. It doesn't only apply to online transactions. And this is, I don't know if this is an intended or an unintended consequence of this ruling, but now it's not just online transactions. It applies to online and offline sales, most importantly, services. Services is something, since you now do not need a physical presence for services, now they're charging sales tax on that as well. So it does not apply though on non-taxable transactions. So for example, food or just any groceries that's actual food, like whether it's vegetables or fruits, it's never been taxed and it will not be taxed as of right now. So what it does do is it adds economic nexus to a existing list of nexus creating activities. So again, it does not change what's tax exempt. It will apply to service providers, and that's one of the big key ones. It will apply to service providers, not just tangible personal property, as South Dakota taxes many services. And then it also applies to manufacturers and wholesalers who sell directly to consumers. So economic nexus and what that is. And the reason why that it's important is because 47% of total state revenue is based on sales tax. And the reason why is because no one's ever gotten elected by saying, hey, we're going to raise your property taxes, or hey, we're going to raise your income taxes. The best way for the states to collect the easiest amount of revenue without quote unquote too much blood on their hands is by collecting an increase in sales tax. So economic sales tax simply is, it's a tax collection obligation imposed based on level of economic activity within the state. So it's not based on physical presence anymore. It's based on revenue, transactions, volume, or both. But like most sales tax laws, economic nexus criteria vary by state. And I'll show you exactly what that means and what that entails. But one thing I want to highlight is actually the impactfulness of economic nexus. So May is when the Supreme Court ruling happened with Wayfair versus South Dakota. Well, as of July 2018, there were 19 states, and those are marked in blue, of the states that are actually moving on to the economic nexus model. However, this is as of July. Now look at it as of October 4th, 2018. As of October 4th, you now have 29 states. So 10 states have been added in the last 3 months. It's not a question of if your state's going to be doing it, it's a question of when your state is going to be doing it. And as you can see, Florida as of right now is not affected, but I would bet a lot of you guys who sell into other states do business in the Southeast, whether it's North Carolina, South Carolina, Georgia, Mississippi, Louisiana. So this is a really, really impactful slide, and it's just showing you exactly what you're going to be expecting. Andrew, do you have any comments on this?
Yeah, I do. I mean, just a couple of thoughts on Nexus. In some regards, I think that states becoming harmonized on this issue may end up being helpful for us at the end of the day. In my experience and going back a couple of decades, I was kind of surprised selling to, I don't use the word consumer, but I'll use the word end user. and finding myself and my company that I was working for at the time in kind of a challenging position in a sales tax audit. It had to do with Texas, and Texas had a very unique definition of nexus at that point in time. And the situation was we had sold construction products on a contract to a subcontractor who was licensed to collect sales taxes and did not charge them tax because they were selling it to the project that they were working on, very large commercial project. We found out many months later, 18 months or 24 months later, that in fact, the expectation of the state was that we would have collected sales tax because a contractor was delivering a project that was related to construction. So very obscure sort of definition around what constituted nexus for that for us as a reseller when we didn't even believe that we were selling to an end user at that point in time. And I guess the challenge for myself and my colleagues who have been selling to end users, particularly in the technology space over the last few years, has been really knowing when we have a nexus situation with the state. It's very hard to keep track of, did we have a salesperson go into that state? Is the particular item, as we'll see on one of the slides that George has later on, in fact taxable in that state? And it absolutely has varied across states in my experience selling to end users, whether or not services were taxable. So it has been a very sort of ambiguous issue to have to deal with from a compliance standpoint. And as someone on the managerial accounting side trying to run an accounting department, very costly to try and be compliant and ultimately, of course, file a lot of tax returns across the country. So that's it, George. Thanks for letting me interject.
Yeah, absolutely. Absolutely. It's all about teamwork here. So, so going into the next slide, there we go. So states in action right now, and this just gives you an example of the differences in the different laws going around the entire country. So for example, in Vermont, as of July 1st, 2018, if they do a certain amount of business in the Vermont, must register with the state and collect and remit taxes starting July 1st. So again, they're going to have, let's say, and it doesn't show here exactly, 200 transactions or $100,000 in sales. And that's usually been the benchmark, but again, every state's different. But if you look in Hawaii, for example, while the new ruling is in effect as of July 1st, 2018, they've actually backdated and say, hey, the Hawaii Department of Taxation recently confirmed the law that took into effect July 1st, 2018, but it also applies to taxable years beginning after December 31st, 2017. Simply put, even if you weren't collecting sales tax, you are still held liable for that sales tax that should have been collected from January 1st, 2018, which is absolutely incredible. But I mean, again, every state's different, so there is no uniform answer. So a few states that are also different is Alabama and Georgia, as you saw. So what should you do? So obviously don't panic. That's the first thing. It is a big change, but fortunately there's a lot of resources at your disposal that can help you. So first thing you should do is call your state and local tax CPA. If you don't have a SALT CPA, we can also help you on that. We do have tax advisory services as well. We can help you determine where you have nexus. We can go on ongoing monitoring services to see when new nexus is established. If you need help registering in new jurisdictions, we can help you with that. Also navigate tasks relating to establishing new nexuses. We have a service that's relatively cheap. We have, I think, 53 people on our tax services board right now. We also have someone that used to work for the state auditor division, the state of California. So it's one of our strongest areas in terms of expertise. But again, call it your SALT CPA first, and if you don't, reach out to us. Our service is relatively cheap. I think it's $1,500 or something like that, just to analyze to see if you have Nexus in a certain area. So also free resources for you that we'll go ahead and send out. Christina will send out to you after this call. This is a free service that gives you the most up-to-date information on Nexus and what states are changing, and also any frequently asked questions guide. So automating compliance is something that we can handle and we can help you with. And why third parties go for tax compliance? The reason is quite simple, is because we did a survey of CFOs, controllers, VPs of finance, and people who who file state tax returns for sales. And we asked, if they were audited, would an auditor find a mistake? Well, surprisingly, or not surprisingly, 75% said that they would be likely to find mistakes within their work. And the problem is that no one's ever gotten a promotion by saying, hey, you did this right, you know. But the problem is that it's a thankless job, it's a tedious job, it's complicated. And what can happen is you can cost your company hundreds of thousands of dollars by not automating it. You know, one thing I like to equate automating sales tax is 20 years ago, everyone kept their payroll in-house. You know, payroll was a service that everyone had in-house, and now try to find one company that has payroll in-house. Why is that? Because it's a non-revenue generating activity. And at the end of the day, I think sales tax compliance is a little more complicated than payroll, but it costs employees about $67,000 to $400,000 to just run an audit and be compliant as a whole. So it can be very valuable. Andy?
Yeah, I guess my perspective on this, I've been through a number of sales tax audits over the years, again, working primarily in wholesale distribution, selling to end users from time to time, selling to other resellers. And, you know, from my perspective, it's don't risk a lot for a little. The experiences that, you know, that I've had in the past where audits did have findings and maybe there was nexus or there was some taxability determination over a transaction that we've done, you know, we're faced with a couple of years later going back to a customer and saying, here's your tax bill. Well, it's really, really hard to collect those, right? We're still liable for the tax. We've been assessed in an audit. We may or may not have had some recovery with our customers. Better if perhaps you have an ongoing relationship with that customer and they understand. Those customers may get use tax audits, by the way. They usually get flagged if you know, they're found to have not been charged tax over a series of large transactions. So you know, I think that automation is absolutely the key. And a little bit later, I'll share one of the positions that we took in one of the companies that I was at on this particular topic. But thanks, George.
Yeah, absolutely. So top performing organizations are 72% more likely to leverage real-time updates to tax regulatory changes. Why is that? Because there was 40,000 tax changes last year alone. Imagining trying to figure out what the tax rates are for your own state, much less states across the country, California, Colorado, Utah, and I'll go into some of those examples as well. So they're 3 times as likely as having automated workflows for tax preparation, filing, remittance, and recovery. And again, I'll show you that as well because it is a time suck. So tax calculations is just the tip of the iceberg. You have nexus, product taxability, jurisdiction assignments. And the reason why jurisdiction assignments constantly change is because of redistricting or gerrymandering, depending on which side of the political fence you fall on. Exemption certificates. Let's say you don't collect sales tax. You still need an exemption certificate to let the state know why you didn't collect that sales tax. Audit readiness. If you're going to get audited, are you having all the paperwork at hand ready to go? And then also state and local tax prep and filing. And I'll show you how crazy that is in itself. So any efforts spent on sales and use tax compliance and related activities. They're just non-revenue generating activities. And people can be doing a better use of their time, like streamlining their accounts payable department, streamlining the accounts receivable department, looking at the feasibility of bringing a product to market within a certain demographic or geographical area. That's a better use of a controller's time or a VP of sales, of finance, or something like that. Let me just show you the utter ludicrousy of sales tax and why it's complicated. So in terms of rates alone, take, for example, a bagel in New York. If you have a bagel in New York, well, it's considered a food, so it's considered tax-free. However, if you slice that bagel in half, all of a sudden there's a tax associated with it. Why? Because it's prepared food, and prepared food is taxable in the state of New York. Also take, for example, a candy bar in Indiana. If you buy a Hershey bar in the state of Indiana, well, it's candy, right? So a candy is taxable. However, a cookies and cream Hershey bar is tax-free. The reason why is because there's wheat flour in that cookies and cream Hershey bar. And wheat is a subsidized item in the state of Indiana and considered non-taxable. But you also have services as well. Snow removal in Ohio is taxable. However, it's exempt in Illinois. And then tree trimming in California, it's taxable if you use lights, but the labor is exempt. My favorite's in Texas because this one makes absolutely no sense. If you buy 5 donuts or less in the state of Texas, it's taxable. But if you buy 6 donuts or more, it's tax-free. Why do you ask? There's no method. It's insane. So the point here is that there's no uniformity. But it's not just limited on that as well. Software is taxed 450 different ways against 45 categories. Whether you're using canned software, whether it's downloadable software, whether it's tangible personal property, there's so many ways of taxing it. Imagine being a software company trying to figure out what the sales tax rates are in a particular state. So let's say you finally have the buy-in and say, hey, we'll have you automate our products with the tax rates. I can do the returns myself. Well, I'm going to show you why returns are not or calculating rates yourself is not going to help either. So take, for example, Denver. So take Greenwood Village, for example. So you would think, hey, let me use 8011, and that would be the tax rates that I would use. Well, that's not correct. And the reason why is because, again, of redistricting, because of or gerrymandering. So depending on that, because different districts have been redistricted or gerrymandered, now all of a sudden there's 6 different tax rates for one zip code. So you would miss on 1 county, 2 counties, 3, 4 other counties, and then not to mention all these football district tax, science cultural district tax, Arapahoe County tax. There's 1, 2, 3 different taxes that you can do on county alone, and then you also have 3 cities. So because of that, it's just a very time-consuming being able to calculate that. So, and then saying, hey, I'll file the tax returns myself. Well, we have someone that has been with Avalara now for several years, but they did 30 years as a CPA. Well, it took them 2 hours to do a California state sales tax return. And I'm going to show you why that's a little crazy. So let me just go over here exactly what the California state tax return looks like. So here's page 1. Here's page 2. Here's page 3. Now, if you noted, as of page 3, you have to break down your sales into every single city. Every single city. It's not just down to the county level. So you have to calculate what the sales are for every single city and what the rates are for each city as well. So how much time would it take for you to calculate the rates for every single city? Because I already showed you Greenwood Village, Colorado, and how long would it take to figure out that? Now imagine having to do it for every single city in California. Is this necessarily the best use of your time? Andy, what are your thoughts on this?
Well, my thoughts are more like bad memories. I've had a lot of firsthand
Nice.
experience with California, and it goes beyond sort of the jurisdictional thing. A while back you were talking about taxability of items. California's got a very unique way of looking at intellectual property software. And many manufacturers of technology equipment will ship, and this is almost like donuts or candy bars, right? Only this is something that would be, more relevant to a commercial business. When you ship a piece of hardware into California, and that hardware has some software content that's embedded, but not provided with the access codes. So in other words, ships on every device, not enabled on every device. That software is considered physically delivered with that device, even though the customer pays for the token to unlock it. And so understanding the obscurity of that and being able to manage it with the customer, particularly upfront. So customers in California who you're shipping product to are used to having to pay sales tax on software that is delivered to them shrink wrapped, but they're not used to software that is downloaded being taxed, right? So any virtual delivery of software content, not taxed in California currently, could change any minute. But if you had a device ship and in fact the software was there and it just needed a token or a code to unlock it that you paid for later, now that software is taxable again. And with some of the corporate buying that goes on, for large systems, that can actually amount to a lot of money. So California has been, I went through an 18-month sales tax audit with California, and they had no sooner wrapped up than they scheduled the next audit because they were going to look at the next period. And the findings weren't, huge, but there were a lot of transactions, and it was just fertile ground. They had people in the city where I was working who lived in the city. They didn't travel from California, but they were employees of California in the city that I worked in, who did nothing but audit on behalf of California. They were state of California employees. Same thing with Texas. We had Texas sales tax auditors, happened to be Denver at the time, as if we didn't have our own, challenges with jurisdictions in Denver. We had sales tax audits from other states who, lived in those zip codes. So anyway, I love the California example. I'm glad you used that one.
Perfect. Yeah, it's a nightmare. And as it's the 7th largest economy in the world, chances are, if you're not doing business in California, you will be doing it soon. And this alone is reason to at least look at Avalara. So we're the only company that is an end-to-end sales tax suite solution. So not only do we calculate your taxes, and we're the only company that also guarantees our tax rates, we also manage your certificate exemption certificates. We currently manage 18 million exemption certificates for our customers. And then we also file returns. And also returns, we make sure that everything is filed on time, and we guarantee the on-time filing. But no other company keeps everything in-house and is an end-to-end solution. And with security being as testy and sensitive as it is right now, having all your information in one company just brings an additional peace of mind. So we're accurate. Again, we're the only company that guarantees our rates, and then we're efficient. We were born and managed in the cloud, and the reason why that's important, and one thing that kind of resonates with me is that we're a technology company that does taxes. We're not a tax company that does technology. And the distinction there is that we've created some technology that will seamlessly integrate with your solution, whether you're using a CRM with Salesforce or a NetSuite. We actually have our connector for Avalara created by NetSuite. So we worked hand in hand to create that connector. You can't get better. We have over 600 integrations, whether it's an ERP system, a POS system, e-commerce, billing. We do it all. So it is a seamless transition from whatever system you're working with right now to us. And we also have 20,000 users that use Avalara to get tax compliance right. We currently have a lot of different companies. We do all the VAT taxes for Amazon in Europe. You'll notice that we have Dick's, 3M, Adidas. We have a ton of logos, and fortunately, we're very good at what we do. And I can't tell you how excited I am to work for a company as dynamic as this. It really is.
Yeah. So, and George, just to butt in for a moment, I have firsthand experience, not just working with Avalara, but actually being the one to implement it in a $500 million company at the time. And, we were in a situation where as our company grew and it got more and more difficult to figure out whether or not a salesperson had flown into a state where we didn't have an office, or we had some other kind of promotional activity going on that would create nexus, or whether the services that we were providing, maybe we sold out of one office in the Northeast and we were delivering into another state and that service was taxable. We reached a point where we simply conceded nexus across the United States. And with that, we signed up with Avalara to provide all of the services that George has been describing on the preceding slides. We had a very, very good experience doing that. I found it to be very cost effective, and we had an absolute seamless integration with NetSuite, which we were using for CRM and ERP at that point in time. So our quotes went out with sales tax from that point forward, and we did all the back-end processing, all our filings, payment remittance, etc., was all done using Avalara. And I can tell you, we saw a marked change in how the sales tax auditors were looking at us once we, started to have that cutover point. This period of time in the past were self-generated, self-filed, and this period of time going forward, where Avalara is our partner, we suddenly found ourselves in a much more less scrutinized position. I think that they saw the automation, and the audits just got much more efficient at that point in time.
Perfect. Andy, can I have you on all my calls?
we can work something out.
Perfect. Well, that's all I have. Again, I'd like to thank Nextern for letting me speak to all you all. It was a privilege and an honor. Thank you very much. Thanks, Christina and Andy, to co-host this with me. It was great. If you have any questions, please feel free to ask.
I would love to thank everybody for attending the first webinar. We look forward to our next webinar. Will be on planning for ERP. What does that look like to prepare the organization for bringing together ERP planning the right way? I'll double check and see if anybody has, I don't have anybody looking to answer a question. So, okay. All right. Well, thank you all for coming. I really do appreciate it. And thanks again for coming.
Yep. Thank you. And we'll see you next time.